This episode of the Intelligensis Africa Risk podcast was recorded on April 9th, 2025. The situation surrounding U.S. tariffs is highly fluid, and details may have changed by the time you're listening. You're listening to the Intelligensis Africa Insights podcast, where we decode the global trends reshaping African markets. I'm your virtual host, Ama, and in today's episode, we'll look at the new tariffs imposed by the U.S. on global imports. President Donald Trump unveiled a sweeping global tariff regime targeting nearly every country on Earth. Africa wasn't spared. In fact, some African countries have been hit harder than longtime U.S. trade rivals like Japan or Taiwan. Preferential market access for African countries under African Growth and Opportunity Act, or commonly referred to as AGOA, was a casualty of the new tariffs. So, in this episode, we're asking, what does this mean for African economies? How can African governments and businesses respond? And what's coming next in this fast-moving storm of tariffs, trade wars, and power politics? We'll also hear from leaders across the continent, from Ghana, South Africa, and Kenya, as they weigh in on how this moment could reshape Africa's global position. The global economy just got a lot more complicated, and for Africa, the stakes couldn't be higher. On April 2nd, U.S. President Donald Trump announced a sweeping overhaul of the country's trade policy. At the core of the new framework is a baseline 10% tariff on imports from more than 180 countries worldwide, including nearly every African nation. For countries that the U.S. deems to have unfair trade advantages, due to trade surpluses, non-tariff barriers, or currency manipulation, tariffs go even higher, in some cases reaching up to 50%. Let's listen to a portion of President Trump's official announcement.
So it's 67%, so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything, but now we're going to charge. European Union, they're very tough, very, very tough traders. You think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%, so we're charging them essentially half. Vietnam.
While much of the global commentary has focused on China and the European Union, the implications for Africa are profound. According to data compiled by the Size Africa program, 51 African countries are directly impacted by the tariff regime. 29 countries fall under the baseline 10% rate. 22 others face steeper tariffs, ranging from 30% to as high as 50%. To put it into perspective, Lesotho now faces the highest tariff rate of any U.S. trading partner at 50%, equal to the rate applied to China. These tariffs apply to a wide range of sectors, from textiles and agriculture to minerals and light manufacturing, with only a few exclusions, namely pharmaceuticals, critical minerals, and select defense-related materials. Equally significant is what was not included in the announcement. There was no exemption for AGOA, the African Growth and Opportunity Act. That effectively suspends the zero-duty trade access that many African countries have relied on since 2000. This isn't just a trade policy shift. It marks a fundamental change in how the United States engages with global markets, placing national interest and bilateral leverage over multilateral cooperation. Coming up next, how the rest of the world is responding and what early market reactions are telling us about the depth of this disruption. Within hours of the new U.S. tariffs taking effect, the global economy reacted, swiftly and sharply. Equity markets from New York to Tokyo experienced some of their steepest losses in years. The S&P 500 shed over 10% across 4 days, before a sharp rebound on April 9th following President Trump's temporary pause for certain countries. But that reprieve excluded China and triggered further escalation. Beijing raised tariffs on U.S. imports to 84%, matching Washington's tone and further destabilizing global trade flows. Meanwhile, Europe's pharmaceutical giants, Novartis, Sanofi, GSK, lost billions in market value after Trump hinted at impending tariffs on medical imports. The stock's 600 healthcare index dropped nearly 6% in a single session. In Asia, semiconductor-producing economies like Taiwan and South Korea are bracing for fallout. Supply chains in tech, telecoms, and consumer electronics are facing recalibration as firms reassess exposure to the American market. Commodity prices have also reacted. Oil rebounded as trade disruptions raised concerns about energy supply bottlenecks. Meanwhile, metals like aluminum and platinum, key African exports, are seeing volatility as tariffs shift demand. On the diplomatic front, pressure is mounting. The European Union has begun crafting a coordinated response. India, Japan, and Vietnam are entering talks to secure exemptions or favorable adjustments. The World Trade Organization has been inundated with filings and challenges. What's emerging is a new playbook for global trade. Less multilateralism, more bilateralism. Less predictability, more conditionality. The countries best positioned to adapt will be those with negotiation leverage, diversified export markets, and the agility to pivot industries. But what about those that don't fit that profile? Those with high export dependence, commodity-linked revenues, and limited fiscal buffers. That brings us to Africa, perhaps the region with the most at stake in this global reshuffle. Up next, we examine how African economies are being caught in the crossfire of this tariff storm. Before we dive into Africa's exposure, here's a quick intelligence break from us here at Intelligensis. This isn't just a trade story, it's a market volatility story, a supply chain recalibration story, and a policy risk forecasting story. And that's exactly where Intelligensis comes in. We work with public and private sector partners across the continent to help them answer questions like, which sectors are most vulnerable to U.S. tariff exposure, today and 12 months from now? How could changing U.S., China dynamics reshape commodity pricing or sourcing for African exporters? Where are the new opportunity corridors emerging, from BRICS trade shifts to AFCFTA pivots? Whether it's a deep dive sectoral brief, a scenario-based trade risk forecast, or a strategic response model for navigating global disruption, Intelligensis offers tailored, Africa-centric insights to help leaders move with confidence, not guesswork. If your organization is navigating these global shifts, visit us at intelligensis.com, your partner in risk and strategy across the continent. Now let's zoom in. What does all this mean for Africa's economies, industries, and trading partners? Africa may not have been the intended target of the U.S. tariffs, but it is unquestionably among the most vulnerable. 51 African countries, out of 54, were hit with new U.S. tariffs starting April 3rd. Countries like Burkina Faso, Somalia, and Seychelles were seemingly not impacted by the tariffs for some reason. For 29 of those countries, a baseline tariff of 10% now applies. But for the remaining 22, including Lesotho, South Africa, Madagascar, and Botswana, the tariffs are far steeper, reaching up to 50%. Let's zoom in on some of the hardest-hit economies. Lesotho, one of the largest exporters of textiles to the United States under the now-undermined AGOA framework, is facing a 50% tariff on most of its garment exports. For a country where over 40,000 jobs, about 10% of the formal workforce, depend on that sector, the consequences could be profound. Madagascar, the world's top exporter of vanilla, also ships large volumes of textiles to the U.S. Those exports are now subject to tariffs of up to 47%, raising costs dramatically for U.S. buyers and potentially pushing Malagasy producers out of the market. South Africa, which exported $2.7 billion worth of goods to the U.S. in 2024, is now grappling with tariffs on citrus, automobiles, and metals. The platinum sector, which made up 26% of South Africa's total exports last year, is particularly exposed. Meanwhile, Nigeria and Angola, Africa's leading oil exporters, are being hit from another angle. While crude oil itself is exempt from the new tariffs, the broader disruption is affecting demand patterns, investor confidence, and ultimately, fiscal revenue. Nigeria derives nearly 80% of its export earnings from oil. Any drop in prices or volume hits hard. Beyond individual countries, the broader macroeconomic risks are intensifying. Currency volatility is already underway. Several African currencies, including the Ghanaian cedi, Nigerian naira, and Kenyan shilling, have weakened further as investors reassess risk. This raises import costs and puts pressure on central banks already battling inflation. Debt vulnerability is another key concern. Many African countries, particularly those under IMF programs, have limited fiscal space. Tariff-induced trade shocks threaten foreign exchange reserves, just as external debt repayments are accelerating. And then there's the bigger picture. The U.S. tariffs effectively dismantle AGOA, the African Growth and Opportunity Act, which for over 2 decades provided duty-free access to U.S. markets. In 2024 alone, AGOA supported over $9.4 billion in African exports to the United States. That preferential regime is now being eroded, without warning, and without a clear replacement. For many African producers, the U.S. is no longer a stable trade partner, it's a volatile risk factor. So the question now isn't just what Africa has lost, it's where it turns next. Coming up, we'll try to understand the U.S. motives regarding these new tariffs and assess the potential risks for America itself. On the surface, the logic of tariffs is simple: protect domestic industries, penalize trade deficits, and reassert negotiating power. But when it comes to Africa, the strategy may be self-defeating. Let's start with the composition of Africa's exports to the U.S. This isn't a flood of cheap electronics or subsidized goods flooding American shelves. Over 51% of U.S. imports from Africa in 2023 were raw materials and commodities, mainly oil, platinum group metals, gold, diamonds, cobalt, and rare earths. In fact, many of these materials are essential to the United States' own industrial and technological goals. Let's take cobalt and manganese, vital for electric vehicle batteries, or rare earth elements critical to semiconductors, defense systems, and clean energy infrastructure. Over 60% of global cobalt production comes from the Democratic Republic of Congo, and a significant share of platinum and manganese, both central to catalytic converters and battery chemistries, comes from South Africa. These aren't commodities that can be easily or affordably sourced elsewhere. They are geographically concentrated, and China, by the way, already dominates global refining capacity for many of them. So when the U.S. imposes broad-based tariffs on Africa, including on countries that supply these minerals, it risks disrupting its own supply chains and increasing its dependence on competitors. And this comes at a time when Washington has spent the better part of the last decade trying to build stronger trade ties with African countries, precisely to counterbalance China's influence on the continent. Think about it. The U.S. has invested in special envoys, private capital funds like Prosper Africa, and programs to secure strategic minerals from friendly nations. Now, that same continent is being treated to a tariff regime that puts its key exports at a disadvantage, without distinction between value-added goods and raw materials. Worse still, the AGOA framework, which helped position the U.S. as a partner in Africa's industrial growth, is being eroded. That opens the door wider for China, India, the EU, and even Russia, all of whom are deepening economic and strategic ties with African nations. In short, the tariffs may win political points at home, but at the cost of long-term U.S. interests abroad. Especially in Africa, where the future is demographic, mineral-rich, and geopolitically up for grabs. Coming up next, how African leaders are responding and what this moment reveals about the continent's evolving position in the global trade architecture. So, how are African leaders responding to this global trade shock? Let's begin with what we've heard directly from the continent's top decision-makers.
As regards the United States, like any other country, is a sovereign country, and they are entitled to take decisions in whichever way they want to, like ourselves. We are a sovereign country, and we can decide on any matter that has to do with our international dealings with others. And so it is within our right, as it is within their right. They have imposed tariffs, and we are examining the impact of those tariffs on us. And as the Minister of Trade and Industry and Competition said, we will be able to state what our position is. So in the end, these are matters that we are going to continue dealing with in a very responsible and very, very proper manner. And we are not a government that will just act out of spite, and we are not a government that will act out of emotions. Everything that we do, we examine very carefully and look at the implications and the impact. So that is exactly what we are going to do.
Speaking there, President Ramaphosa underscores South Africa's measured posture, one of sovereignty, analysis, and discipline. He emphasizes that retaliatory action won't be driven by emotion, but by a careful assessment of national interests.
We all accepted a rule-based trading system, and it has served the world well because it has led to quite significant growth in GDP across the world. It is unfortunate that without resorting to the rules-based system, one country unilaterally decides to increase tariffs across board on all countries. A multilateral world serves us all better than unilateral world, where people just take decisions based on only their country's interests. We must look at the broader global partnerships and the global interests rather than just our parochial national interests.
In Accra, Ghana's President John Mahama voiced clear concern in the clip you just heard. In his remarks, he warned that unilateral tariff hikes by global powers threaten the very architecture of rules-based global trade. His message? Africa must not be sidelined in decisions that reshape the international order.
The Africa Continental Free Trade Area brings into being the largest single market of 1.4 billion people in 55 countries, with a GDP of close to 3.4 trillion.
And in the excerpt you just heard from Nairobi, Kenya, President William Ruto struck a proactive tone, calling for accelerated implementation of the African Continental Free Trade Area. His message is unmistakable. Africa must strengthen its internal markets to reduce dependence on volatile external relationships. These statements reveal a spectrum of strategies, from caution and critique to continental consolidation. But let's move beyond the podium and into the data. Africa exported roughly $40 billion worth of goods to the U.S. in 2024. That's less than 1% of total U.S. imports, but for some African nations, the U.S. is a top destination. Take Lesotho, for example, where over 80% of apparel exports go to the U.S., often under AGOA preferences. Those garments now face tariffs as high as 50%. Or Madagascar, which has built its niche around vanilla and textiles, also heavily reliant on U.S. access. The impact won't be evenly spread. It's the smaller, export-focused economies that are at greatest risk. On the flip side, Africa holds serious bargaining chips. The continent is a major source of cobalt, manganese, rare earths, graphite, and platinum group metals, all essential for EVs, semiconductors, aerospace, and green energy systems. Consider this. Africa supplies over 70% of the world's cobalt, a core component in electric batteries. South Africa alone holds over 90% of the world's platinum reserves. The Democratic Republic of Congo, meanwhile, produces more than 2/3 of global cobalt output. In short, the US may have imposed tariffs, but it still needs Africa's resources. This presents African leaders with a window of opportunity, not necessarily to retaliate, but to renegotiate and reframe the terms of global supply chain participation. Amid these global shifts, Africa's internal trade infrastructure is being stress-tested. The African Continental Free Trade Area now connects 54 nations, covering a market of 1.3 billion people and a combined GDP of over $3.4 trillion. But so far, implementation has lagged. Less than 20 countries have fully operationalized guided trade under the framework. The current tariff crisis could change that. We may see accelerated efforts to reduce non-tariff barriers, improve transport corridors, and fast-track digital customs systems. If African economies can shift even a fraction of their external trade inward, the results could be transformational. So, Africa's strategic posture isn't passive. It's evolving. From cautious diplomacy to assertive integration, the choices African states make now will shape the continent's positioning for the next decade of global trade. So far, we've focused on what's happened, but let's turn now to what's possible. Because in moments like this, when global norms are in flux and political decisions ripple across borders, it's not enough to describe events. We need to forecast, anticipate, scenario plan. At Intelligensis, we've mapped out 3 plausible paths the world, and Africa, could follow as this new tariff regime takes root. Let's walk through them. Let's review 3 possible scenarios. The first scenario will game out what happens if these sweeping tariffs become the new status quo. The second scenario will look at the implications of selected African countries succeeding in securing bilateral exemptions from the tariffs. In the third and final scenario, we will forecast the fallout that will result in an escalation and full trade war. In this first outcome, the US maintains its current tariff structure, a 10% global baseline, higher rates for countries like China, Vietnam, and much of Africa, but no further escalation. Instead of retaliating, most governments simply adjust. Supply chains absorb the cost, markets recalibrate, and global trade settles into a new, if less predictable, rhythm. But for Africa, this stability comes at a price. Preferential frameworks like AGOA fade into the background. Countries like Lesotho, Madagascar, Mauritius, and South Africa lose key market advantages, especially in textiles, automobiles, vanilla, and citrus. Oil exporters like Nigeria and Angola face reduced margins as American buyers seek cheaper sources, or simply reduce demand. This scenario favors larger, diversified economies that can pivot quickly toward Europe, Asia, or intra-African trade. But for smaller, export-dependent nations, it's a slow erosion of competitiveness. In this scenario, the tariffs remain, but become more flexible. The US uses them as negotiating leverage to strike bespoke, bilateral trade deals. Countries that align strategically or economically with Washington can secure exemptions. In return, they lower tariffs on US goods, open up investment channels, or offer critical minerals on favorable terms. For Africa, this could mean a fragmented playing field. Countries like Egypt and Morocco, with strong security or investment ties to the US, may negotiate relief. Kenya could revive talks initiated under previous administrations. South Africa, facing pressure from its automotive and citrus sectors, might seek quota-based adjustments. But what about Lesotho, Eswatini, or Botswana? Without strategic clout, they risk being left behind. This scenario rewards diplomatic agility, but it undermines the continent's collective leverage and increases inequality between African states. The third and final scenario is by far the least desirable for African exports as well as the international market. This is the most disruptive path. Global trade tensions spiral. The U.S. enters full-blown economic confrontation with China, the EU, maybe even Canada or Japan. Tariffs fly in both directions. Supply chains fracture. Investor confidence falters. Inflation and recession fears return. For Africa, the collateral damage is severe. Exports to the U.S. drop sharply. Commodity prices decline. Currencies weaken. Debt burdens rise, especially for countries with high exposure to dollar-denominated loans. Energy-exporting nations like Nigeria and Angola face fiscal strain. Countries reliant on remittances, aid, or development finance suffer from shrinking inflows. In this world, African governments may pivot eastward, toward China and BRICS nations, but those markets may also be constrained by their own economic fallout. This is the scenario of volatility, divergence, and declining global cooperation. So where does this leave us? Each of these scenarios is plausible. None of them is certain, and the eventual outcome may blend elements of all three. But for Africa's economic planners, the time to prepare is now. Because the question is no longer whether the global trade order is changing. The question is, how fast, how far, and who adapts best. Further actions by the U.S. government and responses African countries over the next few months will be crucial in determining if the rift in Africa-U.S. trade widens or can be reversed. So, what have we just witnessed? Not just a change in tariff rates, but a shift in the global trade imagination. The United States, a longtime architect of free market multilateralism, has pivoted sharply toward a protectionist, transactional trade order. And while the initial impact is numeric, percentages, duties, and deficits, its true weight is geopolitical. Africa wasn't the target, but it may be among the most structurally exposed. Why? Because preferential access like AGOA is not just a trade tool, it's a bridge to competitiveness. And when those bridges burn, the detours are costly. For mineral-rich economies, the stakes are high. For labor-intensive exporters like Lesotho or Madagascar, the margins are thin. And for small island economies, like Seychelles or Mauritius, market diversification isn't just strategic. It's existential. But here's the broader point. This moment is not just about tariffs. It's about leverage, about which voices shape the global economy, about who adapts fastest when the rules shift. As we look ahead, a few truths hold. Markets will remain volatile. Trade relationships will become more tactical. And uncertainty, well, that's not going anywhere. But so too does the opportunity remain for countries, companies, and coalitions that move with clarity and data-backed foresight. That's where we'll leave it. The post-AGOA era is not theoretical anymore. It's here. What emerges next for Africa will depend not just on Washington's next move, but on the continent's ability to navigate, anticipate, and lead. You've been listening to the Intelligensis Africa Insights podcast, where we break down the world's most urgent stories and decode what they mean for the continent. This episode was recorded on April 9th, 2025. As we've said, things are moving fast, so remember, some tariff rates and facts may have changed by the time you hear this. If you found value in this deep dive, subscribe to the podcast on Spotify, YouTube, or wherever you listen. And for more insights in real time, follow Intelligensis Risk and Strategy on LinkedIn, Facebook, and X. And if your organization is navigating the storm of global tariffs, shifting supply chains, or uncertain markets, reach out to us at intelligensis.com. We offer tailored intelligence reports, risk analytics, and strategy briefings that help African decision-makers move from reaction to readiness. Until next time, stay informed. And thank you, as always, for thinking with us.